In this lesson, I'm going to talk about risk graphs, or profit and loss diagrams. Here's what we're going to cover: what a risk graph is and why we use them, the basic components of a risk graph, breaking down a long and short stock position. So what is a risk graph? A risk graph, also known as a profit and loss graph or profit and loss diagram, is a visual tool in options trading. It's a two-dimensional graph that shows the potential profits or losses for an options position. It clearly illustrates how the profit and loss, P&L, of a position change when the price or volatility of the underlying asset moves. So the building blocks of a risk graph: you've got the profit and loss axis, okay, the y-axis here on the left. You've got the underlying price axis, the x-axis, which is on the bottom, going across. And you've got the break-even points, basically the line here, because you got profit and loss, so the break-even would be right here. And profit and loss zones will also, I'll go over that in a little bit. But obviously the profit zones are going to be up here, and the loss zones are going to be down here. So the y-axis reflects the financial impact of the position as a result of the price change in the underlying assets. The x-axis on the graph represents the stock price at various points to illustrate how changes in the market price of the stock or the underlying would affect the investor's profit and loss. So when the price moves up or down, that's this here, the price is moving up here, the price is moving down this way. That will also affect the overall position. And it's on this x-axis here. Now this horizontal line here, this one right here, that's neither profit or loss, it's called the zero line or the break-even line. It represents the point at where profit and losses are at zero. Essentially, it's the break-even level for the option strategy. So above this line, then the strategy is profitable. And if your points are below the line, then it's unprofitable. So interpreting a stock position on a risk graph. So here's an example of a long stock position on a risk graph. A bullish investor buys one share of stock at the current market price. Let's say that's $100. So this is an example of buying something at $100. If this price drops by $50, then they can lose $50, right? So stock price goes down, right, to the left. And you can see that, we were breaking even, but as the price goes down, we're following this down. And in this example, it would be down by $50. So the maximum loss of the initial price of the investment is minus $100, right? If the stock price goes to zero. So it can just keep going all the way down until it reaches zero. So the break-even point is at $100 per share. So if the price of the stock does not change, right? If it stays right here, the price stays here at $100, you're just not going to make or lose any money. You're going to just be right here at this break-even line. Okay, but going down here, going up here. So the break-even point is at $100 per share. If the price of the stock does not change, again, there's no gain or loss. Now the reward, if the price rises to $150, so from $100 it rises to $150, the investor gains $50 because we can look up here and extract that it's going to be up $50 right here, right? So it went this way. And the profit can be unlimited as the stock can just keep rising. So this line could just go on forever, depending on, what the stock price is. Currently at 150, you can kind of see where it would meet. And it would be up $50. So here's an example of a short position on a risk graph. So it's just the opposite, right? So you start at $100. A bearish investor shorts 100 shares at $100 each, hoping to buy them back for cheaper. That would be what this looks like on a risk graph. So if the price rises to $150, so it started here, but on, of course, this axis here, it rises to 150, then they would lose approximately, right, $5,000. So you can see here, it would kind of coincide, the 150 and the minus 5,000 would coincide right in here. So the risk is high as the price could rise indefinitely, and it could cause unlimited losses as you can do when you short, because the price of the stock can go to an infinity, but on the downside, it's not so bad. It can only go to zero, right? But the break-even point is at $100 right here. So here's the price of 100. So if we look up here, this would intersect here at the break-even point. If the price falls to $50, the investor gains money, right? So it goes from here and down to $50. And then we look where it intersects this line here, and it's up $5,000, right? So the maximum gain is $10,000 if the price drops all the way to zero. How to visualize risk. So there's four quadrants. A risk graph can be divided into four quadrants by two perpendicular axes. The horizontal axis represents the range of stock prices, right down here. And the vertical axis represents whether you're in a profit or loss, this right here. Each of the four quadrants reflects a different outcome of an investment strategy based on the combination of, profit and loss and the stock price and all those kind of things. So when you plug something in here, you'll be able to get into one of these four quadrants, depending on, your initial, what you initially put on and, what's happening with that trade. So the profit and loss zones. So the graph clearly shows area where the strategy results in a profit right above the break even. This is all profits. If you have a point here or up here, you're going to be in a profit zone. And then there's areas where there's a loss below zero. So if you intersecting your line here or here, you're going to be at a loss down here. See, below the break even line. So a long stock position indicates a profit above the zero line. So here is the profit zone. So any price, see the price would be along here. Anytime the price goes up, you're going to be in this profit zone here. Or if the price goes down, you're going to be losing in this losing zone here. So a short stock position indicates a profit above the zero line and a loss below. So this is when you're short, you'll be making money in this quadrant, and you'll be losing money in this quadrant where the price of the underlying goes up, you're losing, and the price of the underlying goes down, you're winning. So it's a stock. So you can see these are opposites. Short stock position versus a long stock position. Now, the upside versus the downside. So the upside, the right side of the risk graph, this right here, represents a position upside. So this is if the underlying goes up. That doesn't mean you're going to make money. You could lose money or you could make money. But if the underlying goes up, this is the right side here. And the left side of the risk graph, the left side, represents positions to the downside. So the price of the underlying went down. Now you could make money if it goes down, if you're short, or you could lose money if you're long. But the left side here is the downside area, where the underlying goes down in price. So potential for profit if the stock increases, referred to having potential upside, or the risks of a loss if the stock price decreases, right here you can see, known as risk to the downside. So you have risks to the downside here, profit to the upside here. This is a bullish position. Now with the bearish position, you have the opposite. You have the potential for profit if the stock price decreases. So it starts here and decreases down. You're going to hit this zone here where you're going to be profitable. Or if the stock price increases, it goes higher, and you're short, you can see the risk is down here in this quadrant. And you're bearish. This is a bearish position. Next, I'll get into a live example. So here is an example of a long position. I'm long 100 SPY stock. And here's what it would look like in the risk graph. Of course, we have the price here. And if it goes up, you can see that it correlates and makes money. See you're making money here, or this would be down money. So if it went down, you'd end up in this quadrant where the price would go down because you're long, and you can see your correlation. Let's say it went down to 420, then you would be down 31% and down $7,707. So I'm looking over here, right? So you can see how that works. Or if it went up to 560, you'd make about $6,437 approximately. So you can see how the risk graph works with a long position. Here's a risk graph with a short position. It's minus 100 shares of SPY stock, and you can see the price down here of the price of SPY. It's currently at 496.76, and then you can see whether you make money up here or lose money, and you can see the two quadrants, one here to the upper left and to the lower right. So if the price of SPY went down to, let's say, 440, you could correlate it here, and I'm looking over here to the right. You can see that it would be, you'd be up around $5,570 approximately. But what if you were short 100 shares and the price went up, right? This is the price going up. What if it went up to 580? Well, you can see here at the 580 mark, you'd be down at minus $8,458 approximately. So you can see here, being short shares, and this is how a risk graph would work. These are the quadrants that you would be in if you were short 100 shares. We'll see you in the next lesson. My new book, it's out, called All Market Trading Profits. And for those who don't know me, my name is Carl Dahm, and I'm also known as the Transparent Trader. My marketing guy, he convinced me to write a book that shares my secret trade details with you. It's the same trade I used to make $597,210 in third-party verified profits from 2019 to 2023. I'm not sure how long I'll keep these secrets in my book, so you might want to grab a copy before I change my mind. Don't miss out. In my book, I reveal the unique trade structure I developed, something you won't find anywhere else. The book isn't AI-generated content. It's real organic material. If you're interested in learning the trade that drives over 70% of my net worth, click the link in the description to get the book and see how I achieve my results. The book is $30 on Amazon right now, and I'm offering a downloadable version for only $5. See that link in the description.